All right, everyone. So I appreciate you taking the time here to join us today. My name's Matthew Crescenzo, one of the financial advisors here at Secure Planning Group. On this call today, we're going to go through our outlook for 2026. So let's get started. So first thing we're going to touch on is overview of the economy. So while the U.S. economy should be sluggish in the first half of 2026, it is also expected to avoid a full-blown recession due to the tailwinds of easing monetary policy and business-friendly dynamics with the One Big Beautiful Bill. The lagged effects from a slowing job market, softer wage growth, and nagging inflation will dampen growth in the first quarter of 2026. But as business and households regain their footing from uncertainties due to 2025, we expect 2026 to grow close to 2.1%, higher than 2025, but not as fast as seen in 2024. Fiscal spending and strong business investment in artificial intelligence infrastructure is expected to provide crucial support for the economy. The insatiable demand for cutting-edge technologies like data centers, which we're all aware of are big topics right now, advanced semiconductors and AI-driven software is fueling significant capital expenditures by tech giants and businesses across various sectors. The demand for intellectual property will be a pillar of growth, and we expect IP will have an increasing slice of the economy. As seen here in the slide, you can see that the majority of the US spending is through consumer spending and on goods and services. However, intellectual property is creeping up. Now let's touch on inflation and what we expect to see. Inflation will not likely decelerate as fast as policymakers would hope, yet still expect the Fed will continue its rate cutting campaign in 2026 as it balances inflation's concerns with risk of labor market and overall economic growth. Ongoing factors such as new tariffs could push general inflation slightly higher, but softer household demand will cause inflation pressures to recede in 2026. But in the near term, investors will have to bear the burden of hotter inflation. As I'm sure on a lot of people's mind here is the housing market. So the housing market is worth highlighting as we work our way through a new year. Mortgage rates have been stubbornly high, but have fallen in recent times. Looking ahead, we expect mortgage rates will continue to come down, but it's important to set expectations appropriately. A cut in the Fed fund rates does not necessarily mean mortgage rates will fall. Mortgage rates are primarily influenced by long-term interest rate dynamics, which are sharpened by fiscal outlook and the 10-year Treasury yields rather than just Federal Reserve short-term policy rates. In layman's terms, you're not going to see a direct correlation right away when those change. While the fiscal policy results in large deficit and heavy Treasury issuance, investors often require higher yields to compensate for increased supply and inflation risks, pushing mortgage rates higher. But 2026 should look to be a year of declining mortgage rates, creating some support for home buyers, as we know that has been a very tough subject for a lot of members. As we look to forecast growth of GDP and trade uncertainties will stunt the Eurozone's economic growth. High relative energy costs coupled with broader structural weakness in productivity and technological capacities limit the Eurozone's international competitiveness and risk to constraining growth below US levels. Plus, many members of states are implementing fiscal tightening measures, which act as a drag on growth. Japan's goal of virtuous cycle of sustainable inflation driven by robust wages growth looks more likely in 2027 than in 2026. The nagging question for investors are the pace of future rate hikes and the timing of the terminal rate, which is complicated by ongoing global economic uncertainty and the government's desire to support growth. Now let's touch on what we expect from equity markets this year. The S&P surged more than 80% over the last 3 years of this bull market, excluding dividends, far outpacing historical averages. Reminder, this data is based off of 12/1 of 2025, as seen in the figure here. If history is a guide, then the bull may have more room to run. The S&P has averaged a 12.8% gains historically during the fourth quarter of bull market since 1950. with 6 positive years out of 7. In previous instances, when the Fed cuts rates when stocks were at or near record highs, and in seen here, it's been 28 cases, the S&P was higher 13% of the time on average 12 months later, with 93% of those 28 periods preceding gains. When the US economy was not in a recession, around a rate cut, the average 12-year return for the S&P 500 increased to 18%, with all gains in all 21 periods, as seen here on the slide. As I'm sure AI has been top of mind for everyone, let's address what we're seeing coming for this year. Estimates for 2026 capital expenditures from the 5 hyperscalers is expected to approach 520 billion. So when looking at, you're talking Amazon, Microsoft, Google, Meta, Oracle. This equates to roughly 30% increase over the year's estimate and an estimated 1.6 of the US economy is measured by normal GDP. In terms of dollars, that can help drive the economy and corporate profits. Nothing is bigger than AI right now, and that is unlikely to change for the foreseeable future at this moment. As I'm sure we're all aware, the Magnificent Seven has been responsible for more than half of the S&P 500's earnings growth for the past few quarters and will likely to continue to play a significant role growing earnings in 2026. The wide gap between the Magnificent Seven's earnings growth and the rest of the market will likely persist well into 2026, supporting large cap growth stocks, but monitoring that gap potentially narrowing. So another big topic here will be as we enter into the midterm year, let's discuss kind of where we think things stand. So currently, the Republican majority in the House is razor thin, as they hold just 219 seats, one more than the 200 needed for control. This represents the slimmest margin since 1931 and significantly increases the risk of a shift next fall. In 20 of the last 23 midterm elections, the president's party has lost seats in the House with an average decline of 27 seats. So pretty significant change there. Historically, midterm years have been challenging for equities since 1950. The S&P has averaged a modest 4.6% gain during midterm years, with an average maximum drawdown of 17.5%, marking its most volatile and weakest performing year of the 4 years of the presidential cycle. Once political uncertainty subside, markets tend to rebound. So typically what we end up seeing is once we have an understanding of where things are going to go, you see the market tend to calm down. Now let's touch on what we're seeing from the bond market going into 2026. Market pricing suggests that the Fed rates cutting campaign could end by the second half of 2026 with a through rate of around 3%. If market pricing is right, it is likely the 10-year Treasury yield will remain around 4%. It's unlikely the Fed will cut rates to levels that would take the 10-year Treasury much lower. Thus, we think anywhere between a 3.75 to a 4.25% 10-year Treasury yield range for 2026 is appropriate, at least of where we see things now. Upcoming, likely dovish changes to the FOMC should help prevent the 10-year yield from drifting meaningfully higher. Despite recent challenges, the broader credit markets is not in a crisis, nor do we think we are on the cusp of a systematic credit issue. Our issues in the market are in market valuations. Credit spreads or the additional compensation of owning risky debt remain historically tight, given these rising idiosyncrasy risks. While yields may appear attractive, spreads remain below longer-term averages, and we are arguably not providing sufficient compensation to take these emerging credit risks. Agencies, MBC, and investment-grade corporates should outperform treasuries given a higher starting yields for both asset classes, but given our view on rising idiosyncratic risk within the corporate credit markets, we still have a marginal preference for MBS over corporates. As the Fed continues to cut short-term interest rates, cash yields will come down as well, which should also allow high-quality fixed income markets to outperform cash holdings once again. A stable or slightly higher interest rate environment and even tighter spreads are needed for high yields and leverage loan sectors to outperform the core sectors, as you can see over here in the diagram. So let's also touch on another category here, alternative investments. So M&A activity has been trending up both in terms of number and deals and the value of these deals supported by the deregulatory policies, rate cuts, and increased demand in AI transactions. As you can see here, we have seen a significant uptick and a trend going in that direction. What would also be important to touch on is currencies and where we see that going. Despite recent volatility, the dollar's long-term uptrend remains intact. The 2025 drawdown found support from a secular trend dating back to 2011. A sustained move above 100.35 could confirm a short-term bond bottom, targeting a range of between 104 and 105. Positioning and sentiment are improving, suggesting potential upside from short covering. To break a long-term uptrend, the dollar would need to fall below September's near low of $96. That would likely signal a new bear market cycle, shifting from consolidating to resumed downward trend. Key downside risk for 2026 includes escalating trade tensions, a weakening U.S. economy, and capital rotation into outperforming international sectors. One of the other topics we would want to touch on are commodities, which have been a big sector, recently and over the past year here. So several macro catalysts could support commodity prices. Potential rate cuts and lowering treasury yields may weaken the dollar, providing a tailwind for commodities. Stimulus from the OBBA and possibly recovery in China could further boost demand. Trade policy remains a wild card, obviously, as we see some things going on recently. Additionally, the green energy transition and surging investments in AI infrastructure are expected to drive sustained demand for several commodities. While these factors could collectively push commodities into a super cycle, headwinds remain, such as a bear market in oil. So gold remains a consistent outperformer across commodities and has even exceeded the S&P 500 returns since the bear market low in 2022. Russia's invasion in Ukraine in early 2022 and seizures of over $300 billion of Russian dollars reserve prompted a swift central bank pivot to sanction these assets. So gold has been a major beneficiary as the central banks have continued to ramp up purchases with no slowdown in sight. Gold prices have been further supported by the safe haven demand stemming from conflicts in the Middle East, trade policy uncertainty, and even the passage of the OBBA, which renewed fiscal deficit concerns. So to consolidate this, as we did go through a lot here for you, the U.S. economy is expected to experience a modest slowdown in early 2026 before rebounding later in the year. Underlying resilience from AI-driven investments and fiscal spending should help offset a weaker household activity and steer the economy clear of the recession. A cooling labor market and softer demand will help ease inflation, though prices pressures are expected to linger. We anticipate the Fed will proceed with rate cuttings gradually in 2026 and balancing inflation concerns with a softening labor market. To highlight, and quick summarize on stocks, the bull market appears to be poised to extend its run in 2026, fueled by ongoing enthusiasm around artificial intelligence and further easing of monetary policy from the Fed. However, with valuations running high and mid-cycle years often bringing more volatility, gains may be more tempered in 2026. Maintaining current allocations and staying patient for pullbacks to selectively increase equity exposure, right? Looking for opportunities is always the best idea when looking to buy. Our S&P 500 fair value target range for 2026 is between 7,300 and 7,400. With regards to alternative investments, given the evolving market dynamics, we continue to favor strategies that offer enhanced diversification, down risk mitigation, and potential for excess. Within private markets, we remain constructive on infrastructure and secondaries both have demonstrated reliance on steady growth throughout the year. Bonds and cash. Bonds continue to offer compelling income opportunities, with starting yields still evaluated relative to high historical norms, with the 10-year Treasury yields anticipated to remain between 3.75 to 4.25% in 2026. Investors should focus on income generation rather than price appreciation. So as the Fed lowers the short-term interest rate, returns on cash will continue to decline, making high-quality bonds within intermediate-term maturities more attractive for the long term. Currencies will remain respectful of the dollar's long-term uptrend. The rebound in the big tech leadership pro-growth stimulus coming from the One Big Beautiful Bill Act, growing carry trades, appeal in the dollar, and potential upside to economic and earnings expectations could keep the trend intact. With regards to commodities, we maintain a constructive view on commodities while recognizing heightened uncertainty around global trade dynamics, monetary policy shifts, economic growth and trajectories, and the durability of AI infrastructure investments. So we continue to favor precious metals, support by our view that many of the same catalysts that drove outperformance in 2025 will continue. So here you will see we have a couple fun disclosures that you will go through as you touch on this. So we will go through these. Again, this is being recorded and will be shared with everyone. So if you do want to go back to this, you can always look through it. And so I want to thank everyone for their time today. Reminder, I'm Matthew Crescenzo from Secure Planning Group, one of the advisors here. If you do have questions about your account, where you see things are going or want to learn more, please reach out to your current financial advisor. If you're not currently working with anyone from organization, please reach out to us at the information here. Please also make sure to look at our website where we have additional financial guidance and other insights into the market, along with some of the other services we can help provide. So I want to thank everyone for their time today and appreciate you staying with us. Thank you.